Constantinople, 1595, or Istanbul to modern ears, or Constantinople to those of a more traditional perspective. In the grand halls of the Topkapi Palace, a desperate auction is underway. The Sultan's treasury is nearly empty. Wars with the Habsburgs have drained the coffers. The Janissaries are demanding back pay. And the man responsible for filling those coffers, the Grand Vizier, has a solution. He's selling the right to collect taxes, not the taxes themselves, the right to collect them. A wealthy merchant from Thessaloniki steps forward. He offers 1,000 akse for the tax rights to a fertile province in Anatolia. The deal is simple. Pay the Sultan up front, then go collect whatever you can from the peasants. Whatever you can extract beyond what you're paid, that is your profit. The merchant wins the bid. He borrows heavily to finance the purchase, and now he has a problem. He paid 100,000 akse. He needs to collect at least 150,000 to make back his investment, pay his loans, and turn a profit. The peasants in that province can realistically pay maybe 80,000 without starving. So what does he do? He squeezes, he extracts, he strips the province bare. He doesn't care if the farms fail next year. His contract is only for 3 years. He doesn't care if the peasants flee. That is also someone else's problem. He doesn't care if the roads crumble or the irrigation systems decay. He won't be around to see the impact. He is not building an empire. He is liquidating one. And this system had a name, Iltizam, tax farming. And over the next 300 years, it would hollow out one of the most powerful empires in human history. Not foreign armies, not technological change, not plague or famine, a business model, an incentive structure, a choice to extract rather than build. I'm Ari Van Gemeren, real estate investor, fund manager, and your fellow student of history. And today on the Timeless Investor Show, we're going to explore what I believe is one of the most important patterns in human civilization. Because the Ottoman story isn't unique. It's the same story that destroyed Rome. It's the same story that hollowed out Spain. It's the same story that ended British hegemony. And it may be the story we're living through right now. The pattern is simple. Societies that stop building and start extracting are societies that are approaching terminal decline. So let's dive in. Before we go deeper into the Ottoman case, I want to lay out the pattern clearly because once you see it, you'll see it everywhere. Here is how civilizations die. Phase 1, building. A society invests in productive capacity. They build roads, aqueducts, farms, factories. They develop human capital, education, skills, institutional knowledge. They defer gratification. They plant trees whose shade they will never sit in. And it's hard. It requires discipline. It requires long-term thinking, but it creates real wealth, the kind that compounds over generations. Phase 2, success. The investments pay off. The society becomes wealthy and powerful. They win wars, they dominate trade, they attract talent. Life gets comfortable. This is the proverbial golden age. Phase 3, the pivot. Here's where things get dangerous. The society discovers that it's easier to extract value from what's already been built than to keep building new things. Why invest in a factory when you can financialize existing assets? Why train engineers when you can hire consultants? Why maintain infrastructure when you can sell it to a private contractor for a one-time payment? Extraction feels smart at first. You get money now instead of later. You reduce overhead. You unlock value from underperforming assets, which leads to phase 4, the decay. But extraction has a cost. Every dollar you extract is a dollar you are not reinvesting. Every system you outsource is institutional knowledge that you are losing or draining from your society. Every productive asset you strip mine is capacity that's just not coming back. The decay is slow at first, and then it accelerates, and by the time it's visible, it is often too late. Phase 5 is the collapse. The society that built nothing has nothing left to extract. The barbarians show up, or the bond markets, and there's no productive capacity left to resist them. The empire falls. The cycle begins again somewhere else. This is the story of Rome. This is the story of Spain. This is the story, in some respects, of Britain. This is definitely the story of the Ottoman Empire. And the Ottoman tax farm is one of the clearest mechanisms ever devised for institutionalizing phase 3, the pivot from building to extraction. So let me explain how tax farming actually worked, because it's absolutely wild. In the early Ottoman Empire, taxes were collected directly by salaried government officials called emirs. These were bureaucrats. They had fixed salaries, they collected what was owed, maintained records, and sent the revenue back to Constantinople, or Constantinople as they called it at the time. The system was boring, but it worked. But empires grow, as they always do. Wars get expensive. And sometime in the 15th and 16th century, the Ottomans discovered a seemingly brilliant innovation. They could get money now instead of waiting for tax collection cycles. Here is the mechanism. Instead of sending a salaried official to collect taxes from a province, the Sultan would auction off the right to collect those taxes to a private contractor called a multazim. The multazim paid the treasury up front, a guaranteed lump sum, and then they went to the province and collected whatever they could. And the difference, as I said in the beginning, between what they paid and what they collect was their profit. From the Sultan's perspective, this was genius. Immediate cash flow, no waiting. It's almost like let me collect money today from my society and fill my coffers. No administrative overhead. The contractor handled all the work. The risk transfer, bad harvests were the contractor's problem, not the government's. And predictable revenue. You knew exactly what you were getting. Sounds pretty nice, right? It's pretty much the same pitch we hear today whenever someone proposes privatizing a public asset. Let the private sector handle it. They're more efficient. You get your money up front. In the short term, it actually worked really brilliantly. The treasury stabilized. The Sultan could finance his wars. Everyone was happy. But here's what the Ottomans missed. The royal we keep missing over and over throughout history. The multazim had no incentive to build anything. His contract was 3 years, maybe 5. He paid a fortune for the rights. He needed to extract maximum value in minimum time. So he didn't invest in irrigation. He didn't maintain roads. He didn't leave reserves for bad harvest. He didn't care about the long-term productivity of the province. That was literally the next contractor's problem. He strip mined the province and he moved on. And the next multazim inherited the depleted asset. So he bid less, or he extracted more aggressively, or both. Each successive contractor squeezed harder because there was less juice left in the fruit. And by the 18th century, this had created a doom loop. Agricultural productivity collapsed. Peasants fled. Provinces that had fed armies now couldn't feed themselves. The empire's productive base was being liquidated to fund short-term consumption. Here's a crazy statistic. In 1695, tax farming represented about 36% of Ottoman central government revenue. By 1800, it was over 80%. The empire hadn't been governed for a century. It had been strip mined. So let's zoom out, because the Ottoman Empire is just one variation of a much, much older story. Rome. In the early republic, Rome built things, roads, aqueducts, legions. They invested in infrastructure that lasted centuries. Some of those roads, by the way, are still in use today. Roman citizens served in the military as a civic duty. They had skin in the game. They were building something that they owned. But as the republic became an empire, something shifted. Success bred complacency. Wealth bred entitlement. Why should a Roman citizen serve in the legions when you could hire Germanic mercenaries to do it for you? Why maintain the aqueducts when you could just let them decay and just buy water from private contractors? The Romans invented their own version of tax farming, the publicani, private contractors who bid for the right to collect taxes in the provinces. Same structure, same incentives, same results. And we know, those of us in the West know all about Roman tax collectors, right? The Apostle Matthew was a Roman tax collector before Christ brought him into the fold, right? Then the publicani became legendarily rapacious. They were hated everywhere, as we saw, as most of us are aware. The provinces were squeezed so hard that rebellions became common. The empire had to spend more on military suppression, which meant more extraction, which meant more rebellion, another doom loop. But the deeper rot was cultural. The Romans stopped building. They stopped innovating. They stopped creating wealth, and they started extracting it from the provinces, from the conquered peoples, from their own future. And by the late empire, the Roman economy was essentially a tribute extraction machine. The legions existed to conquer new territories so they could be taxed. When the conquest stopped, the revenue stopped. When the revenue stopped, the empire could not pay its soldiers. And when it couldn't pay its soldiers, the barbarians walked in. Rome didn't fall to the Visigoths because the Visigoths were stronger. Rome fell because Rome had been hollowing itself out for centuries. The Visigoths just showed up at the right time. And here's the part that matters for us. By the end, Roman citizens didn't even defend their empire. Why would they? They didn't own anything. The land had been concentrated into massive estates worked by slaves and tenant farmers. The average Roman had no stake in their system at this point. When you extract from your own citizens long enough, they stop caring whether the empire survives. Now let's talk about Spain. one of my favorite, because Spain shows a different path to the same destination. In the 16th century, Spain was the most powerful nation on earth. They had conquered the Americas, they controlled trade routes across two oceans, gold and silver flowed into Sevilla in quantities that seemed miraculous, and it destroyed them. Here's what happened. When you have easy wealth flowing in from colonial extraction, you don't actually need to build productive capacity at home. Why manufacture cloth when you can buy it with Peruvian silver? Why develop your own merchant class when you could just hire Genoese bankers, Genoese merchants, Genoese anything? Spain became a conduit. Wealth flowed in from the Americas and it flowed right back out to pay for wars, luxury imports, and debt service. The Spanish themselves built almost nothing. We've talked on this show about the Potosi mines, the fraud, the debasement, the collapse of trust in Spanish currency. But the deeper problem wasn't monetary, it was structural. Spain never developed the productive industries that were emerging in England and the Netherlands. They never built the shipyards, the factories, the financial institutions. They extracted wealth from the New World and they consumed it. By the 17th century, Spain was a second-rate power, despite still controlling an enormous empire. They had land, they had silver, they had everything except the capacity to do anything with it. This is what economists call the Dutch disease, when easy resource wealth crowds out productive economic development. Spain, patient zero. And the lesson is in your face, guys. Extraction is not wealth. Extraction is the consumption of wealth. Real wealth is productive capacity, the ability to create value, not just move it around. And then there's Britain. This one hits closest to home because it's the most relevant and recent to where we are today. Britain in the 19th century was the most powerful nation on earth, the workshop of the world. They built factories, the railroads, the steamships. They had real productive capacity, not extracted wealth, but created wealth. So what went wrong? Several things, but the one I want to talk about is financialization. As Britain got wealthy, the returns from building things started to look less attractive than the returns from financing things. Why build a railroad in Manchester when you can finance a railroad in Argentina and collect interest, sometimes huge amounts of interest, until your bank blows up, as we've covered in prior episodes? So British capital flowed outward. British banks financed projects across the globe, mines in South Africa, plantations in Southeast Asia, railroads across the Americas. The city of London became the center of global finance, and it worked for a while. Britain got very rich from moving money around. But here's what happened underneath. The domestic industrial base began to erode. The talented graduates went to banking, not engineering. The factories got old. The innovation moved elsewhere, to Germany and to the United States. By 1900, Britain was still very wealthy, but it was no longer productive. They were collecting rents on past investments while other countries were building the future. And when World War I came, Britain discovered the cost of over-financialization. They had capital, but not necessarily capacity. They could finance a war, but they couldn't manufacture enough shells to fight one. They had to borrow from the United States, the country that had been building productive capacity while Britain played in finance. By 1945, the British Empire was over, not conquered, just depleted. They had financialized themselves into irrelevance. I want to repeat this because it's important. Britain didn't lose to a military enemy. They were the victors in both major world wars. They lost to their own strategic choices. They chose extraction over production. They chose finance over manufacturing. They chose short-term returns over long-term capacity. So let's crystallize this pattern because it is the same across all four empires. Rome built productive capacity, got wealthy, outsourced military and administration to contractors, extracted from provinces instead of building, hollowed out and collapsed. Spain, similar story, received colonial wealth, consumed instead of building, never developed productive industries, became a conduit, not a producer, and declined into irrelevance. The Ottoman Empire built administrative capacity, got wealthy, outsourced tax collection to private contractors. Provinces were strip mined for short-term revenue, lost ability to govern directly, hollowed out, and then collapsed. Britain built industrial capacity, got wealthy, shifted from production to finance, capital flowed to extraction, not creation, lost their industrial base, and declined into irrelevance. Four empires, four paths, same destination. The throughput line is this. When a society stops building and starts extracting, it has begun to die. It might take decades, it might even take centuries, but the trajectory is set. Extraction feels like you're doing well, but it's not. You're eating your seed corn, you're spending your capital, you're liquidating your future for present consumption. So, where does that leave us? I don't want to be hyperbolic. America is not Rome. We are not Spain. The parallels are imperfect, but the patterns are fairly visible. And I'd be lying if I say that a lot of these do not concern me somewhat. So let's look at the data. Manufacturing as a share of GDP. In 1950, manufacturing was about 28% of US GDP. Today, it's under 11%. We just don't make things like we used to. Now, there's a very, very fair argument to be made here that that shouldn't matter, right? There's also agriculture was a huge, much larger percentage of the US economy to start of the 90s than today. Does that mean that we're worse off? I don't know. It's debatable. A lot of new industries have developed over time. But it is true that we cannot build like we used to. And the number of articles lamenting the US's inability to keep up with artillery shell production alone is very worrisome. I just read something the other day that in the event of a hot war between the United States and China, the US would run out of munitions in weeks, and we don't have the capacity to build them. That is alarming, guys. Financial services as a share of GDP. This, I believe, is a huge problem. In 1950, financial services were about 3% of GDP. Today, they're over 20%. We have become a nation of money pushers, myself included in some respects, right? So I'm saying this what I do is arguably concerning. Although I have some mixed thoughts on real estate, I think there's some value as well. Where does the talent go? In the 1960s, the best engineering graduates went to NASA, to Bell Labs, to the great manufacturing companies. Today, the best graduates will try to go to hedge funds, consulting firms, and investment banks, or they just want to buy Bitcoin, right? What is that? What are we producing? Nothing, but it's creating wealth, right? We've redirected our human capital from creation to extraction in some form or another. Infrastructure. The American Society of Civil Engineers gives U.S. infrastructure a C- grade. Bridges are crumbling. Water systems are failing. We are not maintaining what previous generations built, let alone building new things. Corporate behavior. Public companies are increasingly returning capital to shareholders through buybacks rather than reinvesting in R&D or capital expenditures. In 2023, 500 companies spent over $800 billion on buybacks. That's money that could have built factories, funded research, or developed new products. Instead, almost like it just funded extraction. Private equity, my least favorite industry. And it's a big one. The private equity model, in its worst form, is essentially Ottoman tax farming for corporations. Buy a productive company, load it with debt, extract dividends, cut costs, sell it to the next buyer. Each successive owner inherits a more depleted asset. The Multazim would recognize this playbook immediately. Now, listen, I'm not trying to say that America's doomed. Okay, I'm not saying all finance is bad or all private equity is predatory. There are plenty of people building real things in this country. The innovation economy here is real and fairly robust, and the entrepreneurial spirit is very real. But the direction is concerning. The trajectory looks pretty familiar. We are increasingly choosing extraction over production, short-term returns over long-term capacity, financial engineering over actual engineering. And if history teaches us anything, it's that this trajectory has a destination. Okay, so at this point, you've sat here and you've listened to me talk about collapsing empires for 20 minutes. What do you actually do with this information, right? Let me give you my framework, both as an investor and as a citizen. As an investor, one, you want to own things that produce. If we're in an extraction economy, you don't want to be holding the thing being extracted. You want to own the productive assets that generate real value, regardless of what the financial engineers are trying to do. For me, that's real estate, specifically cash flowing real estate in supply constrained markets. Land is irreplaceable. Buildings provide shelter that people need. Rent is going to get paid for almost everything else in most situations. More broadly, though, it means owning equity in businesses that make things, that provide essential services, that have real productive capacity, not financial abstractions, not tokens, not derivatives of derivatives, real assets that produce real cash flows. Invest in real things. 2, cash flow over appreciation. In a healthy building economy, asset appreciation makes sense. Things get more valuable because the productive capacity is increasing. In an extraction economy, asset appreciation is often just inflation. You're getting an inflation increase, right? Which is fine. It's a hedge against inflation, but it's not enough. Values are rising because money is being printed, not because real wealth is necessarily being created. Cash flow is the truth. If your investment thesis depends entirely on selling to someone else at a higher price, you're speculating on the continuation of an extraction regime. If your investment produces income regardless of what happens to price, you might have something real in your hands. 3, think about political risk. Here's an uncomfortable one. If you believe your society is in extraction mode, you need to think about what happens when the extraction regime breaks down. What happens to property rights if the system gets stressed? What happens to your assets if there's a political realignment? What happens if the people being extracted from decided they have had enough? I'm not saying you should flee the country. I'm saying you should think about jurisdictional diversification. You should think about asset structures that are resilient to political change. You should think about where you want to be if things get rocky. 4. Be a second owner. This is a recurring theme on this show and applies directly here. Extraction regimes create distressed assets. The Multazim squeeze the province dry and move on. The private equity firm loads the company with debt and sells it. Someone has to buy the wreckage. If you have patient capital, long time horizons, and the operational capacity to rebuild, you can buy productive assets at a fraction of their intrinsic value. The great fortunes are built not by extracting, but by acquiring what the extractors have discarded. Be the second owner. And 5, critical, guys, critical, build skills, not just portfolios. If we're heading into a period of institutional instability, financial assets may not be as reliable as they have been. What's always valuable? Skills, knowledge, capacities, capabilities. Invest in yourself. Invest in your ability to create value directly, not just to allocate capital. The Ottoman bureaucrat who lost their jobs to the Multazim probably never recovered. The ones who had real skills found new patrons. As a citizen, this one is a little harder because sometimes individual action feels so insignificant against civilizational trends. But let me offer a few thoughts. 1, support building, not extraction. Seems easy, right? When you vote, when you engage civically, think about which policies encourage productive capacity and which encourage extraction. This cuts across traditional political lines. Policies that make it easier to build housing, to manufacture goods, to develop infrastructures, these are pro-building. Policies that primarily benefit financial engineering, rent-seeking, and extraction, be skeptical. 2, don't participate in the extraction if you can avoid it. Every time you invest in something purely extractive, you're voting with your capital for more extraction. Every time you support a business that strip mines rather than builds, you're reinforcing the pattern. This doesn't mean you have to be a saint. Okay? I'm certainly not. We all operate within the system we have, but on the margins, where you put your money matters. 3, big one. I think we've completely lost this in our society. Think generationally. The extraction mindset is fundamentally a short-term mindset. I'll get mine now. The future can take care of itself. The building mindset is generational. I'll plant trees whose shade I'll never sit in. I'll invest in things that will outlive me. How are you raising your children? How am I raising my children? What values are we transmitting? Are you teaching them to extract or to build value over time? Civilizations are literally just the aggregation of millions of individual choices. If enough people choose building over extraction, the trajectory changes. And 4, for all of my listeners and friends out there who live in the West, the UK, Canada, Australia, the United States, please vote locally. All we focus on is presidential elections, where our vote means the least. Vote locally. The voting turnout in local elections it's pathetic. Like, we don't vote locally, but it's the thing we actually have an impact on, given nobody votes, right? We see radicals on the right and the left get voted into office in our cities all the time because 20% of the citizens in a city vote. And we're talking margins of like 500 to 2,000 people. Vote locally. Make an actual difference. Do something in your local politics. We get so up in arms over Trump versus Biden, whatever. It doesn't matter. Who cares? Like, what matters is your local backyard. Make your backyard nice. Do something about it. All of us in the West, we have the ability to do something in our local elections. So do it. So let me bring this home. The Ottoman Multazim was not evil. It was rational. Given the incentive structure he operated in, strip mining the province was the smart play. The system rewarded extraction, so he extracted. The Roman publicani were not evil. The Spanish conquistadors were not evil. The British financiers were not evil. They were all responding rationally to systems that rewarded extraction over building. That is the tragedy. These outcomes are not caused by bad people. They're caused by bad systems. Systems that make it more profitable to liquidate than to create. And here's the thing. We get to choose what system we participate in. We get to choose where we put our capital. We get to choose what we build and what we extract. We get to choose what values we transmit to our children. The wheel, my friends, turns ever onward. Empires rise and fall, extraction economies eventually consume themselves. But within that great cycle, individuals make choices, families make choices, communities make choices. I choose to build. I choose to own productive assets, not financial abstractions. I choose to invest for cash flow, not speculation. I choose to operate with long time horizons, not quarterly optimization. I choose to align my interests to my investors so that we build wealth together rather than extracting from one another. And we choose to reinvest in our buildings and make our properties better, better for our residents, and better for the future. Upgrade them, enhance them, improve them, love them, you might even say, and create something wonderful. And I choose, lastly, to remember the Iltizam, not as a villain, but as a warning about what happens when short term extraction becomes the dominant mode, a warning about where that trajectory leads. America does not have to follow that path, but we won't avoid it by accident. We'll only avoid it by choosing consciously, deliberately, repeatedly to build rather than extract. The question is not whether you understand this pattern. Okay. You've listened to this episode, you understand it now. The question is, what will you choose? Think well, act wisely, build something timeless. I'm Ari Van Gemeren. This has been another episode of the Timeless Investors Show. And if this episode resonated with you, share it with someone who needs to hear it. These ideas only matter if they spread. Leave a review on Apple Podcasts, Spotify, YouTube, wherever you listen, wherever you are. It genuinely helps the show reach more people who are thinking about these questions. Subscribe to the Timeless Investor on Substack for weekly deep dives into history, behavioral finance, and real estate strategy. Just Google the Timeless Investor. And if you, my friends, are an accredited investor who shares this philosophy, who wants to own productive assets, who thinks in decades instead of quarters, who'd rather build and extract, let's talk. There's a link in the description. Reach out. Let's set up a conversation to talk about what we're doing. We are buying vintage multifamily and supply constrained West Coast markets at significant discounts to replacement cost. Cash flowing deals with real margins of safety and assets that we are improving for future generations to make this country better. There is a link in the show notes. Reach out. Let's build something together. Until next time, thanks for being here. Take care.